Managing options, risk, and positions. It's widely acknowledged by seasoned traders that position management has an outsized impact on your overall profit and loss. So in this video, we will delve into the critical components of developing a trade management plan and tips on how to stick with your plan. Before diving into trade management, let's quickly review one of the most important guidelines many options traders abide by to avoid large drawdowns. A common rule of thumb used by traders is to risk no more than roughly 2% of their portfolio value on a single option trade. For example, with a portfolio of $100,000, every trade should have a max risk of under $2,000. Otherwise, too many contracts could potentially trigger a large drawdown that is difficult to manage or recover from. It will be up to you to decide what is an appropriate threshold based on your own risk tolerance and portfolio. In today's video, we'll explore various triggers that could warrant acting on your options position. Let's first review what to do once you decide to act. The most common action for managing a position is to simply close your position. A to close option order would close out your existing position and remove any further exposure. However, you could also roll a position, where you're simultaneously closing your existing option contract while opening a new contract in one order. With a roll, you're simply shifting your exposure from the existing contract to a new one. This could be for a different strike price and/or expiration date. Now, let's explore the various factors to consider when deciding how to manage your options position. Firstly, the rise and fall of the underlying is typically the first step in gauging when to exit an options trade. However, time to expiration and volatility expectations will also influence an option's value. Let's review the basics of options Greeks to effectively manage these factors. Of the options Greeks, delta, theta, and vega will likely have the largest effect on the value of your positions. As a rule of thumb, long options positions should target a higher delta to theta ratio, increasing your exposure to the underlying, while minimizing time decay. On the flip side, short options positions should target a lower delta to theta ratio to maximize time decay while minimizing the exposure to the underlying. As these ratios change with changes in the market, they can be used as triggers to close or roll an existing position. Now let's examine a couple of examples for potential exit strategies. Most commonly, traders will set an exit threshold based on the value of the option. This should include both thresholds to exit at a loss and a profit. For example, an option buyer may set a stop loss at 50% of the premium paid for a call option. In this example, if you buy a call option for $5, you'll set a rule to cut losses if the value of the option declines to $2.50. And if that option were to increase in value, to set a rule to exit the trade at a profit if it were to reach a 100% gain or $10. Additionally, when a trade is profitable, it is common practice to roll the position to lock in the profits and continue to seek exposure for further potential profits with a new options contract. Some traders may instead prefer to set a threshold to exit an options trade based on the price of the underlying security. For example, if you purchased a call option when the stock breaks out from a resistance level, the breakout level could be used as your exit threshold for a stop loss, and your upside target would act as your exit price to take profits. In the example in this chart, if we purchase a call option on the breakout above $56, we would use the $56 as a stop loss on the options trade. And if it reached our 67% resistance target, that would be the trigger to take profits on the call option. Additionally, it rarely makes economic sense to exercise an option early prior to expiration. However, there are a few exceptions to this. If a call option is in the money with an upcoming dividend, and the dividend amount exceeds the extrinsic value of the option, it's at a higher risk that the buyer may choose to exercise the option to capture the dividend. This often catches traders with covered calls and bear call vertical spreads that are in the money unexpectedly with an early assignment. Also, stocks that are hard to borrow are at higher risk of early assignment, sometimes referred to as a synthetic dividend. The buyer of a call option can benefit from an early exercise by lending out the stock that they acquire through the exercise. And lastly, options that are deep in the money with little extrinsic value are also at a higher risk of early assignment. Another risk that traders of vertical spreads should be aware of is a broken spread. Despite vertical spreads having limited risk, the exception is if the underlying lands in between the two strike prices at expiration and the position isn't closed before expiration. In this scenario, one leg will either be exercised or assigned, while the other leg will expire worthless, leaving you exposed to the underlying security after the expiration date without the other leg to offset any potential risks. This is another reason to consider the practice of closing or rolling all positions prior to expiration. Lastly, corporate earnings can have a material impact on a company's price. For example, for your long options positions, an earnings catalyst can be the driver of potential gains. However, both theta and vega exposure will work against a long option position held through earnings. On the flip side, as an option seller, vega and theta exposure will generally work in your favor. However, your delta exposure will provide the largest risk to both long and short positions. We hope this video has introduced you to the key components of how to manage your options portfolio. Start familiarizing yourself with the tools available on the BMO InvestorLine platform that can assist you with tracking your position's profit and loss, Greeks, and corporate actions. These tools are an invaluable resource for maintaining an updated view of your positions and stay disciplined with your exit strategies. Visit bmo.com/online investing to get started.